Okay, so here's a thought. Benjamin Graham, the father of value investing, once proposed a fee structure so bold it practically dared his clients to believe in him. And yet, just 6 years later, he was asking those same clients for a monthly living allowance. How does that even happen?
That's such a stark contrast, isn't it? You go from being this confident, almost audacious financial genius to struggling to make ends meet. It's like his life was a constant push and pull between brilliance and adversity.
Exactly. And it all started with his frustration over how other money managers were taking massive performance fees, up to 50% of profits. Graham looked at that and thought, I'm delivering results just as good, if not better. Why shouldn't I be compensated fairly?
Right, and his solution was to completely overhaul his compensation model. He gave up his $10,000 annual salary and proposed a tiered fee structure. The idea was simple but bold. He'd take 20% of returns above 6%, 30% above 26%, and 50% above 56%. It was a high risk, high reward setup that basically said, I'm betting on myself.
And that's what makes it so fascinating. On one hand, it was a brilliant move that aligned his interests with his clients. On the other hand, it required an extraordinary level of trust from those clients. Not everyone was willing to take that leap.
That's true. Roe Harris, for instance, outright refused and withdrew his money. And then there was Benjamin V. Cohen, who also left. Cohen wasn't just any client. He was a Harvard Law classmate of Harris, and later became a key figure in American politics. He helped draft the New Deal's economic legislation, including the laws that created the SEC.
The irony of that is almost too much. Cohen helped create the very regulatory framework that Graham had to navigate. And what's even more interesting is that Graham later consulted Cohen on certain provisions of the 1934 Securities Exchange Act. That connection clearly meant a lot to Graham.
It really did. But, Graham wasn't just losing clients during this time. He was also gaining a key partner, Jerome Newman. Newman joined the firm in 1926, and he turned out to be one of the best decisions Graham ever made.
Absolutely. Newman was a Columbia Law graduate and came from a wealthy family, so he had both the skills and the resources to handle the administrative and financial side of the business. That partnership allowed Graham to focus on what he did best, analyzing investments and making decisions.
And their partnership wasn't just a business arrangement, it became a lifelong friendship. When Graham passed away in 1976, Newman was the executor of his estate and even hosted his funeral. That kind of loyalty and mutual respect is rare, especially in the world of finance.
It really is. And let's not forget that the Graham-Newman partnership became a breeding ground for future legends. Warren Buffett, Walter Schloss, and Tom Knapp all started their careers there. Talk about a legacy.
No kidding. But before we get too far ahead, let's talk about Graham's strategies during this period. By the late 1920s, he was managing $2.5 million, which was a massive amount back then. And he had this incredible toolkit of strategies that he used to generate returns.
One of those strategies was arbitrage. He'd find these inefficiencies in the market and exploit them. Like the time he bought DuPont and shorted an equal dollar amount of General Motors because DuPont's market cap was essentially just the value of its GM shares. It was like getting DuPont's chemical business for free.
That's such a classic Graham move, digging into the numbers and finding value where no one else saw it. Of course, arbitrage wasn't always successful. He did take losses when the cheap stock fell further, and the shorted stock rose. But overall, it was a key part of his approach.
Then there were the cigar butt stocks, which are so iconic to Graham's philosophy. He'd look for companies trading below their net current assets, essentially buying a dollar for 50 cents. One example he wrote about was the Tonopah Mining Company. Its stock was trading at $1.37 per share, but the company's cash and marketable securities alone were worth more than that.
It's such a simple concept, but it's brilliant. You're essentially buying a company for less than the value of its liquid assets, which minimizes your downside risk. And it's a strategy that inspired countless investors, including Warren Buffett in his early years.
Another fascinating strategy was his activist value investing. The Northern Pipeline campaign is a perfect example. Graham discovered that the company held millions in high-grade railroad bonds, more than its entire market cap. So he bought shares and pushed for the bonds to be distributed to shareholders.
And when management refused, he didn't back down. He showed up at the annual meeting, even though it was held in a remote town to discourage attendance. He was mocked for his efforts, but he didn't let that stop him. By the next meeting, he controlled 40% of the votes and won 2 board seats.
That kind of persistence is incredible, and it paid off. After a recapitalization, shareholders received $70 per share in cash plus new shares. Graham's average cost was under $72, so his return was about 54%. He repeated this tactic with other companies, earning a reputation as the earliest liquidator.
It's amazing how ahead of his time he was. But not every move he made was a winner. There was the patent company fiasco, where he invested in a tire retreading company and initially made a profit. Encouraged by that, he put even more money into similar companies, only to lose most of it when they went to zero.
That loss must have stung, but it's a reminder that even the best investors make mistakes. The key is to learn from them, and Graham certainly did. Despite that setback, the bull market of the 1920s made him very wealthy. In 1928 alone, his pre-tax personal income exceeded $600,000, a staggering amount at the time.
But even with all that success, Graham wasn't immune to personal tragedy. In 1927, his 9-year-old son, Newton, died of meningitis. And then in 1928, he had another son, also named Newton, who struggled with congenital arthritis and later took his own life in 1954.
That's just heartbreaking. It's no wonder Graham turned to teaching as a way to cope with his grief. He started a securities analysis course at Columbia University, which became legendary in its own right. Some of the greatest investors in history came out of that program.
It's incredible how he channeled his pain into something so impactful. Teaching not only gave him a sense of purpose, but also solidified his legacy. Through his students, his ideas have influenced generations of investors.
And that's the thing about Graham. His life was full of contradictions. He was a genius who made mistakes, a wealthy man who faced financial struggles, and a teacher who turned personal tragedy into a lifelong mission to educate others.
Exactly. His story is a testament to resilience and the power of ideas. Even in the face of adversity, he kept pushing forward, and his impact on the world of investing is immeasurable.
It really is. And I think that's a lesson we can all take away. No matter how talented or successful you are, life will throw challenges your way. It's how you respond to those challenges that defines you.
Well said. Graham's life was anything but easy, but it was undeniably extraordinary, and his legacy continues to inspire and guide investors to this day.
Absolutely. And on that note, I think it's time to wrap up. This has been such a fascinating dive into Graham's life and work. There's so much to learn from his story.
Agreed. Thanks for the conversation. It's been a pleasure exploring this with you.
Same here. Until next time.